Yes, as we always say when we start our session, the discussion would be purely educational. The idea of this spaces is to so as to learn and educate you people, not any buy, sell, or hold recommendation, nothing for or against any company. So this is a discussion in good faith, how we can apply our techno funda things so as to place ourselves better in the market. And anything you want to say, Saurabh?
No, thanks for highlighting, Prince. So, because we are talking about FOMO, usually the discussions are more around buy, but I think this is the spaces where the discussions will be more and more around sell. And we'll be talking about a lot of stocks from sell perspective rather than buy. So, please don't feel bad for it. I mean, I don't have any love or any hate for any stock. I am just being totally unbiased and totally data driven. And even if I am invested in some of the stocks, it doesn't matter. The idea is to bring out the framework, the approach, the insights, the examples, rather than having any biases. So please don't mind for any of these discussions around any stock or market or sector or index or whatever.
Exactly. And guys, like I have pinned the thread by Kumar Saurabh, and you guys can surely have a look at it as and when you get time. So he has tried to summarize all the tweets, timely cautions for the retail investor, which he did time and again. So that has been pinned to the spaces. So Saurabh, let me take a moment to thank you again, first of all, for agreeing to doing this again. And for those, those who are new to his handle, so let me take a moment to introduce Kumar Saurabh. Has a very rich experience, and he clubbed technicals and fundamentals and momentum style of investing. And if you check his handle in the past, you will get to know the great and timely insights shared by him, which was basically so as to caution the retail investors who were out of FOMO, running after the names which were doing rounds on social media. And Saurabh is founder at Scientific Investing, and he has been sharing quality content at Scientific Sharing or Scientific Investing, and he also runs a YouTube channel by same name. And the rich content is freely available to everyone. So those who are yet to check may kindly check. And yeah, so welcome, Saurabh.
Thanks, Prince. Thanks for the kind introduction.
Right. And guys, like there is a little modification in the style of podcast video. So initially we'll be listening our guest for initial 20-30 minutes so as to uh, learn about the topic thoroughly. And in case we have any questions around that, thereon we will open the floor for questions so that we can learn about the thesis seamlessly. So Kumar, Saurabh, all the podcast is all yours, and you can start, please. Thank you.
Sure. Thanks, Prince. So first, welcome everybody for attending. I can see some of my friends here. Manish Bhai is there. Janak is there. So thanks all of you for attending. And it's an interesting topic because usually we talk of buy, but today we'll talk more about sell because the topic is FOMO. And as Prince told, I have a techno funda background. I come from a dual finance and data science background. So that is where the domain knowledge of finance and the skill of data science to look at data unbiased, whether it's a trading data, whether it's a fundamental data, and that has been the reason behind having a hybrid approach. Now coming to today's topic, so again, as Prince said, what I have done is I have created a Twitter thread. I have created a Twitter thread where in last 2 years, most of the tweets which I have made around FOMO, lot of those tweets are there, and I will use lot of them for discussion so that the discussions are more use case based. The discussions are more insightful and applicable than being a merely gyan session. So that is where I will use those thread tweets. So look for the latest tweet which I have made some half an hour back, and that thread we will be using. Now coming to FOMO, so I will divide it into three, four parts. What kinds of FOMO exist in market? Why FOMOs happen? What are the signs of these FOMOs? And again, I will try to break into fundamental science, technical science, psychological science, quantitative science, and all of that. And I will try to exemplify taking some of the examples from those threads, how and why it happened. And then we will open it for discussion and let's have as many questions as possible. So first thing, FOMO can happen in multiple ways. There could be market-based FOMO. So like there could be FOMO around investing in US or investing in Nasdaq, or a country as the next best opportunity, and it has happened in history. Then there could be asset class FOMO, like crypto was, a recent example, and many times in equities itself it gets created. And because most of us we are equity related investor, if we get detail more granular into equity, there are FOMOs related to sectors, there are FOMOs related to themes, and the history is there from 90s, like your ID.com bubble happened in 99 2000. There was big NBFC bubble which happened in 95 96. Then there was a infra real estate bubble in 2007 8. Then there has been a pharma bubble. In last 3 4 years, there was a housing bubble in 2017. Then there was a micro cap bubble, and then recently we have seen bubbles in the form of platform and whatnot. So there are various kinds of sector and themes, and people who come at the end of the cycle, and if they don't exit on time, they end up losing 50 60%. And then the third, there is a stock level FOMO, where there is too much of storification beyond a point, and people get trapped in stocks. So if you look at top down, there are various levels of FOMO, and if we are not playing the game to our advantage, there are chances of injuries at various levels of investing, right from the country to market to asset class to sector to stock. The next thing is why FOMO happens, and my observation has been there are multiple reasons why it can happen, but the first and foremost reason is lack of preparation. And when I say lack of preparation, any kind of investing, it requires a lot of preparation, whether we are investing in a stock or we are investing in a sector or we are investing in a ETF or we are investing in a one particular country fund or any theme. Lot of preparation is required. Whether we are a fundamental investor or whether we are a trader, technical by nature, both needs lots of hard work. In terms of fundamental, it needs a very solid understanding of risk, a solid understanding of valuation. Because when everything is good, there are statements which are made like valuations doesn't matter. If you stay invested for 10 years, you'll make money. But only when things fall apart, then we realize the mistake, or when stock already falls 50%, and then after that some risk gets triggered, and then we realize, okay, this risk has happened. But ideally those risks should be studied in advance. Ideally, what is the price at which one should exit, because there is a chance of 50% falling because the valuations are not in favor. That should happen in the beginning. So lack of preparation is the first reason. Lack of process is second reason. When I say lack of process, what I mean is, many people, they enter into a stock thinking, okay, even if it is overvalued, let me play with the momentum. But when the price falls, they think, okay, I will sell after if it falls 5% more and 5% more. Actually, they don't stick to their discipline. The first place, the whole thesis itself is wrong. You have to know whether you are playing for value or you are playing for momentum. If we are playing for value, we have to look for margin of safety in the valuation. If we are playing for momentum, we have to have a very strong entry and exit process. So if we don't have a process, or if we keep tampering our process, or if we keep switching our process from process 1 to process 2, style 1 to style 2, it is not going to work. And many times FOMO happens because we don't own a process of ours. And if we don't own a process, then we have to be extra cautious. But we don't maintain that kind of caution. The third reason for FOMO is, most of the times it's our human behavior and envy and greed. Because I have done these mistakes, and most of my mistakes of FOMO has been either around envy or it has been around greed. And all said and done, some of the human characteristics are very difficult to change. In fact, I was part of a lot of WhatsApp groups, and many times what happens, there are weeks or months when you don't make money, And when you see other people making money like crazy, whether they're making in real thing, I don't know, but when you hear others making money, you start questioning your own process, or you start thinking, okay, let me also play a little bit and let me make money here. So many times, despite of having skills, still I will end up putting some money, in some stock, which somebody is recommending. I know this guy is good, and the moment you put, the stock starts underperforming. So having that discipline and controlling the emotion is very, very important. Controlling our greed is very important. If our process is telling that we have to sell, but because the whole market is gung ho about it, many times we kill our process and then we pay the price. So emotional lack of emotional control in the form of envy, greed, these are other reasons why FOMO happens. The last reason I would say why FOMO happens is because of lack of understanding of market cycle. And this is something which needs lots and lots of experience. It doesn't happen over 1 year period. And many times, if you see the current market, almost 40% of investors, they are less than 2-3 years old. So market cycle is very important. Even though we don't make a mistake, because we don't understand how things work, we don't realize that we are making a mistake. So if we are playing a cyclic industry, and I have seen it happening again and again, sometimes it will be your typical commodity companies, sometimes it will be sugar, sometimes it will be textile. It's very important to understand the cyclicity of the sector, the cyclicity of the industry, the revenue cyclicity, the margin cyclicity. I can tell you many companies, if you pick, the margins will fluctuate between 10 to 20%. And at 20%, if you look at the company, the ROCE will look good, the leverage will look good, everything will look good. You will think it's a quality company, the 3-year return on equity is very good, the sales growth rate is very good. But actually the company is at cyclic peak. After that, your revenue is going to fall by 20%, your margin is going to fall by 50%. So because all that fall is going to happen, your price will fall by 50%. And the problem happens because we don't understand the sector cyclicity. We end up entering at the top and then holding the basket. The other thing is the market cycle, the whole cycle of the Nifty or stock market itself. Market also works in cycle. And even though it is not something which is driven by greed or envy or lack of preparation, you can say, but we feel that we have done our work, but it requires much deeper work. So anybody entering into sectors which are highly volatile, which are highly cyclic, we really need to think if we are just entering because everybody is talking about it, or we understand it well. And the last one is too much of storification, and it has only got worsened with the advancement of social media, because earlier we only had money control board, 15 years back, but now we have YouTube, now we have Twitter, now we have Insta and whatnot, Telegram groups, WhatsApp groups. And when stock is not doing well many times, and of course there's no right or wrong approach. Value investors also make money, investors who respect margin of safety also make money, investors who are momentum or traders who follow momentum, they also make money. Those who can buy 52-week low stock, if their process is right, they can also make money. Those who buy 52-week high, if their process is right, they can also make money. But what happens is, nobody will be interested. We will say we are investors, but we will not be interested to even study stocks where there is a lot of correction, but we will buy momentum stocks where there is overvaluation. And not all 10 momentum stocks do well. 2 stocks, they will keep doing well because there is still enough value, there is still enough growth. But there are 7-8 companies, some of them will be cyclic, some of them growth will taper, some of them the momentum will go much ahead than valuation, and in some maybe it's sheer supply, because somebody who got in at the early time, he has made a 4-5 bagger, he would like to exit. So if there is enough supply and not many buyers, again a top will be getting created. And those are the times where you will see a lot of Twitter threads, lot of storification, and I'll give you enough examples in terms of platform companies, IRCTC. In fact, some threads I wrote because I found the kind of valuation price discussion, not valuation, the kind of price targets were given, they were absurd, no valuation justified it. And that is why I wrote some of those tweets. So the storification leading to the kind of psychological impact that, okay, this is a lifetime opportunity and I should not miss it. And even though we feel that, okay, things are not in favor of, a very basic back of envelope calculation can tell, the story, it's too overvalued. But then we believe in, buy at any price and quality at any price. So these are some of the reasons why FOMO happens. And now talking about the signs of FOMO. So first sign of FOMO in terms of fundamental, a very simple exercise if you do, you will see your valuation will always be a band. Any company, when you pick last 10 years of 15-year or 20-year of data, whether you're picking a company data or you're picking a sector data, you will see it works in a band. Maybe at bottom of valuation it might work, and I don't know to get into different kind of valuation metric. Whatever valuation metric you take, depending on the type of business and financials, whether it's price to sales, EV, EBITDA, cash flow, doing a DCF, there is a range. And whenever there is lots and lots of correction, everybody is scared, those valuations will be much lower than their historic mean. And whenever there is too much of euphoria and froth, they'll be the upper band of their historic mean. And I did a webinar on valuation, some 4 or 5 hour webinar, and I had taken a lot of example. In fact, my observation was there is a technical analysis in valuation bands also, and there are a lot of examples if you see. And valuation is not a static concept, it's a dynamic concept. Depending on the structural changes of business, the valuation also works, and hence you get re-ratings and de-ratings. But still, in a generalized basis, when you see, these valuation bands still work, and the probability of success at the upper end of valuation bands is very less, and the probability of success at lower end of valuation is still decent. So whenever you incur these kind of signs, at least you have to be little cautious that if the company or the sector is trading at the upper end of the valuation band, at least some caution is required to understand if this is sustainable because of some structural change, or nothing has changed, it is the high cyclicity upper end of the market euphoria. Or many times there is too late entry in popular stocks. So even if you read technical analysis, we talk about stage analysis, and in the stage 2 there are 3-4 big breakouts which happen, and through these 3-4-5 big breakouts, you get somewhere a 50% to 500%, 800% kind of move. And once all of those breakouts and all of those things have happened, then stock consolidates, distribution starts, it starts topping out. So if we are too late to enter in these popular sectors again at higher valuation, the chances are that we will burn our hands. And that is why the sign is, we have to look for how many rounds of uptrend has happened, and then breakouts have happened, and then we should try to match with the valuation. If the valuation is still attractive or fair at least, then many times when the market gets into a FOMO stage where people try to enter with unlimited kind of money, everybody wants to make money in the market, and the typical barber stories, and your colleague who has never invested in market, he will try to invest. Or in 2007, Reliance Power IPO was highly talked about. After that, the next IPO I saw most talked about in the company, because I was working till last year, was Paytm. I mean, in my company, I never heard stock discussions with colleague, and Paytm was one stock where again I saw some kind of discussion happening. And then you see a trend of bhangar caps, lot of penny stock, bhangar cap stocks. They also start doing circuits and all. Most of those stocks being above their 20-day moving average, above their 200-day moving average, above their 50-day moving average. Then the other other sign of FOMO is there is a recent bias in picking quality, and I see many investors getting stuck here. In 2020, it was pharma, that pharma is the best sector to invest. There is no other sector like pharma. In 2021, IT became the best sector to invest. As of like, IT sector never existed in the stock market. Achanak se prakat ho gaya hai. So what happens? These sectors are same. These sectors are there from last 15-20 years. But something happens because they generate lot of return, the growth. The problem is, whenever this phenomenon happens, many times part of that growth is because of short-term tailwinds. Those growths are not very structural, and stock market and life is same. We have a good phase and then we have a bad phase. Again, we have a good phase, bad phase. Businesses are also same. Sectors are also same. They go through good phase and they go through bad phase. Again, if you go through companies which have done 10%, 20% growth rate continuously for 10-15 years with margin expansion, you'll find very few companies. In fact, that is what the book Coffee Can is there. You could find very few companies. But the problem is, we assume every good company and every good sector to continue to do that. And the bigger problem which happens, first, many of us, we enter at the high period, but the bigger trap happens when the stocks start correcting, because the recency bias comes into picture. Oh, this was a great stock and this was a great sector, and this is corrected at 20%, so I am entering at a very good valuation. And again, there are lack of preparation comes. A 20% correction in price doesn't mean the valuation is attractive. So as investors, many times we tag valuation attractiveness as a price correction, which is not the right way. And many people get trapped, and that is why I many times I highlight shareholding data. Like if you take example of Aarti Drugs and many such companies where the count of shareholders went 10 times. Why? Because 2-3 times it went up when it was a late stage of uptrend, and when the correction happens, the correction first traps those late entrants, and then lot of new people, they keep getting added because they feel, okay, it was a quality stock, it has done that great kind of growth rate, I'm getting it cheap, and the new and new people keep getting added, and whereas sellers, they keep throwing the stock lower. So these kind of recency biases of picking quality, and many times even the high quality stocks, they go through multi-year correction. It has happened with HUL in 2010. It has happened with ITC in two occasions. It has happened with Reliance. So those kind of things happen. And in the US market also it has happened. There was a quality bubble which happened in 70s, and those companies, all high quality companies, and they couldn't make money for next many years. If we look in terms of technical, so what happens many times in FOMO, people nibble stocks at distribution cycle, and there are multiple ways how distribution happens. I will talk about few examples. Like if you see charts of IRCTC, charts of IEX, you'll see a very exhaustion kind of move. Exhaustion move is one where, in a period of 15-20 days, the stock goes up by 50%. Or you will see a very big needle getting created at the top, if you know what a candlestick is, which means the sellers have dumped the stock, and somebody who has come in the end, he has taken all the stock, and then that needle sale, that the sellers dominated the market. So those are the ways distribution happens. Or there's a typical very price based distribution you will see in terms of, if you understand what is a trend uptrend is when prices make higher highs and higher lows, and downtrend is when prices make lower highs and lower lows. And very simple visual analysis of chart will say the stock is making lower high and lower low. So you can see those patterns, and those are distribution patterns, but we are so much married to the story. This has happened with Mastech. So again, if you see that thread, I am talking about these stocks. It has happened with Mastech, it has happened with Saregama, it has happened with Loris. But because we are married to the stock, we think, okay, we are long-term investors. See, if you are a long-term investor, and if the valuation is so high that prices can fall by 30%, then you should not get surprised. It's okay to be a long-term investor, but you should be mentally prepared to take a 30% valuation, price cut. But if you are getting surprised by 30% price cut, so either you can be a long-term 10-year investor, but then be prepared to take these kind of 30% drawdown. But if you don't want to take 30% drawdown, then you have to be prepared, and then you have to exit at the right time. Also, very simple examples. So froth happens even at a sector level, index level. Look at NASDAQ. So if we look at NASDAQ, one example, one study which I always do is I look at the 3-year, 5-year CAGR of that index, whether it's a small cap index, whether it's a NASDAQ index, whether it's a large cap index. And most of the times you will see any index has given a return somewhere between 8% to 20%. If you look at Nifty, your CAGR will be around 12%, mid cap, similar numbers. So basically, that is the mean return. In long run, that is the kind of return you will make. So if you are making a 25% kind of return in last 3 or last 5 years in terms of CAGR, it is highly unlikely that in next 5 years you are going to make the same kind of return. It's a very simple price analysis, unidirectional analysis, no fundamental. And when in the last 5 years you have made hardly 3-4% return, and if the GDP is growing at 7-8%, if the 12% CAGR kind need to be maintained, then there are higher chances that you will make more returns in next 4 to 5 years. And I am highlighting more as an investor. As a trader, the game is very different depending on what kind of trader you are there. But I'm talking some of these things purely from a long-term investment perspective, where we look for margin of safety. So these kind of simple analysis, even if you look at NASDAQ, still, I think the 5-year CAGR of NASDAQ is not that bad. Still, it is in lower double digit, maybe 11 to 13% somewhere there, which is not that bad. And at the top, it had gone 24-25% plus. Again, if you go through history, if you plot last 5 year and next 5 year performance of the price every month for last 20 years, you will see a lot of patterns where at the higher band, whenever the returns are more than 2x of the mean, you get tops created, and next 3-5 years are very bad. And whenever your lower band, the last 3-5 years of return are much below the standard mean, that is where the turnaround happens, and the next 3-5 year returns are very good. So you call it quantitative analysis, you call it chart analysis, price analysis, whatever, but these are the symbols. So again, how to identify patterns? So if you go through the thread at a market level for small cap, because in 2021 small cap was in a huge bull run. So there is another data based on 17 years of small cap index. There was never a 25-month continuous period when small cap index didn't correct by more than 15%. And we entered into 15th month, 16th month, and these tweets are there from July 2021. Finally, when we entered into January, we hit 22 or 23rd month, and then we got a 15% plus correction. So all these are patterns, history, probabilities. It's not about predicting कि मेरे को top predict करना है, bottom predict करना है. We have to act based on probabilities, and when probabilities are extremely out of favor, that is how we should take when to take a call on sell and exit. When probabilities are highly in favor, we have to take a call on allocating more, and we have to look for multiple signs, whether these are fundamental signs, quantitative signs, behavioral signs of Google Trends, word trend analysis. There are videos on YouTube where I highlighted some of these Google keywords, and there are technical signs, the chart analysis, the simple trend analysis. And when all of these things are saying the same thing, the probability of a market top or a FOMO or a bottom, all of these increases, and that is how we need to act. So this was my summarization of what is FOMO, why FOMO, what kind of FOMO, signs of FOMO, technical, fundamental, with some of the examples there through the thread. I will pass it to Prince, and